I think the tensions will go up. By the way, the Chinese have a long border here with Central Asia, with Kazakhstan, Kyrgyzstan, Tajikistan, even a small border with Afghanistan, Pakistan. And I think eventually it will come to war. In war times, you want to own commodities, physical. Of course, not paper money and derivatives at UBS and Citigroup. And, but physical, because during war times, along the Kondratiev, when prices go up, tensions increase, prices then go ballistic. Napoleonic Wars, Civil War, then World War I, and then Vietnam. So this is something to consider. The other thing to consider is obviously how will the next war look like? For the last 5,000 years of human history, cities offer safety. I think now the countryside will offer safety. You have to have a house in the middle of nowhere. Nobody will drop a bomb on you. Whereas in the cities, they'll poison the water, switch off the electricity, the internet, your credit card. You won't even get home. You have quarantines because you will be infected and the others don't want to be infected. So if I were you, I would all buy a house in the countryside, far away from any place. The last observation I'd like to make is obviously it's a tremendous economic sophism to believe that you can print your way into prosperity when all the evidence is against it. I mean, if printing of money and debt growth would lead to prosperity, then Zimbabwe would be by far the richest country. The country, by the way, run by Robert Mugabe, the economic mentor of Ben Bernanke. The other point I mentioned to you earlier when I talked about debt to GDP are the unfunded liabilities. Over the last 10 years, actually, the big deficit were the unfunded liabilities that went up. And so the government debt with Fannie Mae and Freddie Mac and General Motors and so forth and the unfunded liabilities is more like 600% of GDP. Then you add the 250% of GDP private credit, then you get something like 800% debt to GDP. I tell you, sovereign credits in the Western world, they're all bankrupt. But before they officially go bankrupt and can't pay, they're going to print money, and massively so. That should be very clear, because that's the easiest way politically to postpone the hour of truth. You postpone the problem to the next president or to the next party or whatever it is, and that, I think, should be very clear. Some people say, oh, they can't print money. As I said, you can send a check to people. You can essentially, when people say, deficits don't matter, I actually wonder, why do people actually have taxes? They shouldn't pay any tax at all. You just finance everything through deficits. It's much simpler. Makes everybody much happier. So, I mean, sometimes I have to say, when I look at the economists in academia, I'm sure they're all very intelligent and that they studied the textbooks except the wrong ones, and B, they're totally inconsistent in their views. Now, the one thing I want to reiterate about an environment where you print money is this. In the late 70s, we had a boom in Latin America, which came about as a result of rapid credit growth. Credit came to Latin America via the OPEC surpluses that were channeled through American banks into Latin America. And then, after 1980, when the oil price no longer went up, Latin America had a credit crisis, the so-called petrodollar crisis. And the Latin American governments reacted like the US government in the last 2 years. They created large fiscal deficits and they printed money. So what then happened is this. The currency, and here I take the example of Mexico. The currency of Mexico collapsed between 79 and 87 by 95%. So if you were unlucky and you bought Mexican pesos here, or you were a Mexican and you held Mexican pesos here, then obviously you lost 95% of your value compared to at the time the US dollar was a strong currency. Now, what was the best way to actually survive this period of rapid currency depreciation? Now, here you have 3 tables. This is the Mexican stock market in local currency. In other words, in peso terms. This is the Mexican stock market in dollar terms, and this is the performance of the Mexican fund, which is run by a fund manager. Now, in local currency, to make things simple, the Mexican market went as the currency tumbled here. There's an adjustment in stock prices on the upside. If I print money, everything in this room will go up. Some things will go up more than others. But the currency goes down. So as the currency went down, stocks in nominal terms or local terms went up. The index from 1,000 here in 79 to a peak of 343,000 in 87. Then we had the crash in 87, global crash. Then we ended up here at 139,000. So from start 1979 to the end here in 1988, we were up 139 times in local currency terms. But of course, in dollar terms, the situation looked different because, as I mentioned, the currency collapsed here completely. So what then happened in dollar terms is this. Depending whether you were lucky or unlucky in the first year of 79 to buy Mexican stocks, you bought them at the high of 70 or at the low of 48 or 45 here. And then they went up to 220 in 87 and then closed at 62 here. So essentially in stocks, your purchasing power was more or less maintained. You didn't really make any money, but you didn't lose any money. Cash holders, of course, they got slaughtered, and bond holders in local currencies also, because the interest rates never really adjusted sufficiently on the upside. So in an environment of money printing, as I mentioned before, cash and bonds are not very desirable. Stocks are not perfect, but still they kind of keep the purchasing power alive. Secondly, and this is important to understand, especially if you are, say, interested in gold. By the way, I'd be interested in this room. How many of you own physical gold and not just a few gold coins inherited by your great-grandfather? Gold. Yeah, this is, a reasonably high percentage. Very bearish people in this room. But I can assure you, normally at conferences, if, say, 3 to 5% of the audience owns any gold, that's about the maximum. And most people, not a meaningful position. But anyway, I'm mentioning this because in an environment of money printing, and as we have, I mentioned the high volatility monetary policies in the US has and will create, the following is important to understand. Here, 1979 to 1984, the currency collapses at a faster rate than the stock market goes up. And the result was that, therefore, as the currency collapses more, then stocks go up in nominal terms or in local currency terms, that in dollar terms, your market went down here from a peak of 1779 down to 5 in dollar terms in 82, 83. By the way, this is very well described in The Economics of Inflation by Bresciano Turoni. I think it's also on the website of the Mises Institute, finally. So, in this period of time, you didn't want to be in Mexican stocks. You wanted to be in US dollars or whatever other assets in the world. But once the currency depreciation had exceeded for an extended period of time the appreciation of stocks, stocks became incredibly undervalued here in the 84, 82, 83 period. At that time, you should have moved back from dollars into Mexican stocks and then ridden the Mexican stock market rally from 5 to 220, because after 83, stocks went up more than the currency depreciation. In other words, you can't be too dogmatic today. You have to shift your assets from time to time. I'd like to also mention, I hope this is very clear, at times the currency depreciation exceeds the appreciation of local company stocks in local currency. You don't want to be in that market. But at times, the stock market in local currency in any country will go up more than the currency depreciation, then you want to be in those markets. I'd just like to mention the Mexican stock started at 10, and then it ended at 7, and it went down in the meantime to 1.72. It underperformed everything because it's run by fund managers. Now, I mean, I'm not overly bearish on stocks. I'm very bearish about everything. I think you're better off in stocks long term for the next 10 years than in cash. We had a negative return over the last 10 years. Usually thereafter you have some kind of positive return of, I don't know, 7 to 8% per annum. The Asian markets are unusual in the sense that the Nikkei was in March 2009 at the 30 years low, same level than in 81. If the S&P went to the 81 level, we would be at 120. South Korea, Taiwan were at 20-year lows. If the S&P was at 20-year low, we would be at 300. So I think that in Asia we had very low valuations. And in the case of Japan, we have essentially bond yields stock yields higher than bond yields. So I think that some Asian markets, from a longer-term perspective, are reasonably attractive. As I said, you should have a piece of land in the countryside. Agricultural commodities are now very depressed. They're probably the most attractive commodities longer term. And as always, I would continue to accumulate some gold. I don't think that gold will always go up and that meaningful corrections cannot occur. But we have to distinguish between smart guys who know how to trade and buy at the low and sell at the high, like Goldman Sachs, that had a profit in every single trading day in the first quarter of this year. Simple people like me prefer to just hold some gold. Because I'm mindful the central bankers are going to print money, no matter, they have no other option. And when it doesn't help, the economy will tank, and the people that advance the argument of output gap, I tell them, why don't you go to Zimbabwe and you look at the output gap in Zimbabwe and you tell me whether output gap and inflation is not compatible? Yeah, sure. I mean, particularly weak economies will have high inflation because in strong economies you don't need to print money. That is the difference. You don't need to have a fiscal deficit. So these are some investment themes. Healthcare, that we have very low healthcare expenditures in Asia as a percent of the population, about 1% of what they are or will be in the United States. Then gold and silver long bonds, I think they may rally for 3 months. That I have no problem. But I think after a 20 years bull market in bonds, I think that the bull market is pretty much at its end, or has, as I believe, ended on December 18th, 2008, and that from here onwards will have higher interest rates. Banks in Asia are relatively safe because they didn't buy a lot of CDOs and so forth. They didn't understand them. And the traffic was too heavy for the Lehman salesman to get to the banks. I think the final crisis will happen. And, you know, you can just postpone a crisis, but eventually you have a major crisis. And I really believe 2008, the financial system went bust. Next train station will be when governments will go bust. And I think in the Western world, they'll all go bust. Before they go bust, they'll print money and they go to war. So everything will be, and all of us will be doomed. Thank you for your attention.